Okay, well, it's been a busy last few months in the alternative space, and it really sort of three key things going on. Firstly, continuing to see lots of new opportunities and exciting developments. Secondly, private markets, which is clearly a very substantial subset of alternatives, continuing to do what they do and deploying capital. And then thirdly, I think perhaps most importantly, alternatives continuing to offer volatility mitigation qualities, and we'll talk about those in a little bit more detail. But just going back to that first point, continue to see lots of opportunities. Just picking out one area that we've seen a lot of activity in and spent a lot of time on in the last few months is in the space of what we call intellectual property or royalties. Some of our followers may already know that there are listed song royalties funds out there. We're looking at one of those. You know, whether it's for this vehicle or not, we don't know, but it's an interesting space. It's very non-correlated. We've also seen money being raised in the healthcare royalty space, again, which is a really interesting part of that intellectual property sphere. And we're actually also working with one private markets small house who are developing a product in book royalties or literary estates. So three different aspects of the same sort of genre, but potentially very, very interesting. Whether, of course, those make it into portfolios is a different question. We talked about the second area, which is private markets doing what they do best. Interesting, a timely point in which to record this. So, for example, this morning, which as we sit in mid-October, we've seen a take-private deal for the UK quoted cybersecurity business Sophos by the large US private equity manager Thoma Bravo, name I know very well, having previously been invested with these guys, but very symptomatic of where we are in the private market cycle. Lots of dry powder that's already been raised and needs to be deployed into exciting businesses. So it's what I say about private markets doing what they do best, slowly deploying capital. And I think the third space which I talked about is those volatility mitigation properties. And just to give you a couple of examples on that, again, running some data from the end of June, which is roughly when I came on board to Janus Henderson, to now, mid-October, just picking up two examples. If I look at the listed private equity name, Harbourvest, it's delivered a return of circa 6% versus a UK equity market return of minus 2%. And again, using the example I talked about earlier, which is song royalties, there's a listed name called Hypnosis. That's delivered a return of roughly 2.5% versus an equity market return of the opposite of that, minus 2.5%. So a very short period to focus on, but again, doing exactly what we'd expect them to do, which is volatility mitigation. If I look at it first from a geographical perspective, let's focus on the two large regions. There's a smidge over 30%, sorry, smidge isn't a very technical term, but there's a smidge over just 30% in Western Europe and North America. And I think just focusing for a second on that North America exposure, clearly we get a number of our key underlying alternative sectors exposure in North America. The currency headwind has helped us, and that's been an important allocation. Going forward, if there's a Brexit deal, we'd expect there to be some renewed confidence in sterling, so you may not see that tailwind persisting in the portfolio, but that's been a great help for us. And I guess the more important part of that is how are we allocated within different asset classes in the portfolio. So I'm just going to dwell on the two largest holdings, which are private equity, which we've got, again, just over a third of the portfolio, and public equity is 18%, and we get a number of exposures through our public equity holdings, some of the listed names that we have in the portfolio. So in terms of where we are from an underlying sectoral perspective, we've got about 31% of the portfolio in private equity, we've got about 18% of the portfolio in public equity, we've got about 18% in hedge funds and 10% in property, and the residual is a number of the other asset classes within the portfolio. I think from a context perspective, and it's worth noting that discounts are widely prevalent across the listed sector. And there are actually very few sectors where a number of these are, where the funds in aggregate are trading at a premium. I think infrastructure and property, the only discrete sectors where they trade at a premium. We're very focused on it. There are a number of levers we can pull. The first is investment execution, doing what we do. Our aim is to deliver investment excellence and to deliver robust, strong NAV growth year in, year out. We think that's probably the best way over time to narrow the discount, but clearly there are other levers to pull, and those include refining and working very hard on the marketing strategy. That involves getting the vehicle in front of as many people as possible. We're totally committed to doing that, speaking at conferences, supporting you as investors by getting other investors on board, making it more attractive, improving the clarity of our communications, all of our literature, and working with analysts to produce external research, whether that's independent or sponsored by us, to get the message out in terms of what we're doing. The third area that's available to us to pull a lever, I suppose, is on share buybacks. They have their advantages, and there are lots of, we can get a degree of momentum using share buybacks, but I think one of the key messages that we've had from many of our shareholders is that they don't want to see the vehicle shrink any further. So for the time being, we think there are probably other things that we can do, and in particular I'd pick up one example where that option may be perhaps in the longer term interests of shareholders more than necessarily buybacks, and that's where we might be able to buy discounted secondary assets, which probably has a more long-lasting effect on the portfolio's growth. So we take all of those into the round. We're very focused on it, but at the end of the day, it's my shoe leather and my colleagues' shoe leather in getting the name out and speaking to as wide an audience as possible, and getting as many buyers in. And, in theory, you close discounts by finding more buyers than creating sellers. So focus very much on doing that.